Hi, and welcome everybody to this webinar regarding IFRS 18 from us at Exsitec and Consolidator. Today, I will be speaking a bit. My name is Edwin, and I work at Exsitec as a financial controller. So I work mainly with our group reporting and our consolidation. And with me today, I have Dina.
Hello, yes, I'm Dina. I work with a Consolidator. I am a consolidation consultant, and I work mainly with the onboarding of new customers and setting up the whole system. I have a background as auditor and financial controller as well, so I have quite a wide experience.
Perfect. That's very good for the theme we're talking about today. And today's agenda will be a short introduction to Exsitec and to Consolidator. After that, we will look at IFRS 18 and what's changing with that new standard. We will have a look at the new account structure, and we will talk a bit about how we at Exsitec are doing this right now to prepare for IFRS 18. And then we have some closing remarks before we say goodbye. But to start out, I would like to talk a bit about Exsitec for you who doesn't know about us. At Exsitec, we deliver integrated IT solutions to a lot of customers. We're present in Sweden, Norway, Denmark, and Finland. We have over 600 employees, over 5,000 customers. That is a bit, we are a bit more right now. Founded in 2000, and we are a public company since 2020. And at Exsitec, we partner up with great systems and help customers make them work as good as could be, and we integrate them so that they talk together. So we make IT work together. And about Consolidator, Dina?
Yes, so we are a Danish accounting tech company. It was built by CFOs for the CFOs, and of course also for state authorized auditors, compliance build, and of course we also supports IFRS, which is why we are here today. So we built the system to have an effortless way to consolidate your numbers and get an output very fast rather than sitting in Excel and do all your journal entries. The system is set up with rules and system accounts to identify your eliminations and do the calculations, for instance, on your NCI. And we are supported by, for instance, the big four companies, auditors. They like the system very much. They use it themselves as well. And we have a group of customers, both smaller and larger groups that uses our system.
Yeah, perfect. I think that was a really good explanation about Consolidator. And also to be clear, we at Exsitec are both a very happy customer to Consolidator. We use it ourselves, or I use it in our group reporting, but we're also a very proud partner of Consolidator, have been for a year or so. So that's why we do this together. So that's very enjoyable. And now we will talk about the main focus on the webinar. What is IFRS 18 and what is really changing when we go into 2027? Well, the key changes and requirements of IFRS 18 is a new income statement structure. And that is what we will focus on in this webinar, the new income statement structure. We also have mandatory subtotals in this new structure. And IFRS 18 also adds management-defined performance measurements. Really nice line. We won't go into details about that. We will, as I said, look at the new income statement structure. But the management-defined performance measurements is in play for all IFRS companies. And the purpose of IFRS 18 is to improve comparability between companies, to add transparency for investors and analysts, and also consistency in the financial reporting. So IFRS 18 doesn't really change how we measure things. IFRS changes how we look at things. And some IFRS changes only applies to a certain company or a set of companies, but IFRS 18 will have an impact on all IFRS reporting companies. So that's a big change. And when we go from IAS 1 to IFRS 18, the income statement will change very much. And today in IAS 1, we have our operating profit, we have financial income and financial expenses. And in the new IFRS 18, we will have an operating portion, we will have investing, financing, and underneath we will have income taxes and discontinued operations. But our main focus today will be to look at the operating, investing, and financing part. And from what I have been told, or when I read about IFRS 18, so the main focus is actually to have the operating part as comparable as possible between companies, and that's why they change the investing and financing, so that it will be very clear what will be in the investing side and what will be in the financing side, and the rest is actually operating. So that is the categories we will be looking at, and to do this and how you can work with adding this structure right now, because IFRS 18 will be in play 2027, but then you would need to have comparative numbers for 2026. So we urge you, and we work with helping customers building this structure right now, so that you don't need to stress a lot in the beginning of 2027 trying to figure out the 2026 numbers. So that is why we look at this now, and we urge everybody to be aware of the changes. And to do this, we need to go into some details. We believe that most of you are listening are aware of the IFRS 18, so we will go a bit deeper into details how you can structure this in a system. Now, we are looking at Consolidator, of course, but we want to give a picture how you could manage this in a system. So we will look at the new account structure, and over to you, Dina.
Yes. So as Edwin just mentioned, it of course, this overview takes the base from Consolidator and how our system looks and with our group accounts, but the view itself or the presentation of it is, of course, for any other company as well. We have here, the focus is on what has changed for your investing and financing portion of it. So anything below your current EBIT. But there's, of course, also changes to what we have under our operating profit and loss. And that I'll just speak through quickly. that for the operating profit and loss, we have, of course, this new FX differences that we need to take into consideration. The FX differences are now required to be presented related to the income and expense that gave rise to the difference. Meaning, for instance, your account receivables, they need to be presented along with your revenue. And so for that, you would need to add in new accounts, both in your ERP system and in your group accounts, where you need to add in these FX differences for your revenue. And we have, at our end, we have decided to present it under your cost of goods sold, because this is where we would focus on the expenses part. There could, of course, also be to some extent, FX differences on your external costs, but it would require too much effort to actually present it under each specific subtotal for that. And then besides the FX differences, we would also have any fair value adjustments that are not related to the financing or the investing. But so this is basically what would change under the operating profit and loss. And then there's, of course, also this required subtotal being the operating profit and loss. It is basically the same as you see currently as your EBIT. So the main changes in the overview will be after your EBIT, now renamed to operating profit and loss. And the changes here are for the investing part, that basically most of what you would have under financial income in your previous overview, what you see here in blue, will now shift into the investing category. And then additional on top of that, we add in the capital loss for investments or on investments. And this is, of course, because the categories are based on the underlying, so to say, asset in this case. So the investment is an investment, meaning even if there's a loss to it, you still have to classify it as investments. So that it's both income and expenses related to your investments. And the same goes for financing. It's anything related to financing, meaning debt and other borrowings. So for the financing part, I'm skipping one point here. For the investment property adjustments, we have previously fair value adjustments on your investment properties. And they were previously in our group accounts presented below your financial items, which is now changed to slide into the investing category. And this is what you see with the green markings. And then we just renamed the way they are named. Instead of having the fair value, we call it investment property adjustments, but it's basically the same topic. And then for our financing side, it's more or less all your financial expenses without the capital loss on investments, of course. And then for both the investing and the financing, we, of course, need to present also an account for the gain and loss on foreign exchange rates, like I also mentioned on the profit and loss, because there could be FX differences here that are related to our investing or our financing. And last but not least, we also have fair value adjustments of our debts, which would, of course, then relate to a financing liability, meaning you would have to present it under the financing. And that's the last three accounts we see in our overview here. Is there anything you would like to add in on this, Edwin?
No, I think it's really good. it is here is where we get really detailed oriented, but you can't really speak about it without going there when we talk about consolidation and a system and how we should prepare and how we should understand how the IFRS will look 2027. So I think it's really good.
Yes. Sorry. Yes.
Should I talk a bit about how we do it or in Exsitec, or do you want to?
I maybe just wanted to add one quick thing, because of course this overview here that I'm showing with the financing and the investing is of course for any reporting entities that would be presenting it the classical way, so to speak, and not having a specified main business activity, which is also a new concept within the IFRS 18. And the main business activity specification or assessment is something that needs to be done on every single entity. So for instance, an entity that would provide financing to customers would have a different layout. The financing would then be part of the operating profit and loss. So there would be a different presentation of it. But this is going into a lot more details. So it's just to mention that this is, of course, for any entity with no specified main business activity. Yeah.
That's a good point, that you need to know your business and how it fits into the IFRS 18. So where to classify it. Yeah. Perfect. And now I would like to talk a bit about how we do it at Exsitec right now, because like we said, it's in play 2027, but we have to have the comparison numbers of 2026. So like Dina said, we have added in our group reports, we have added new accounts to our group structure. And this means that when we add the new structure for IFRS 18 in our current structure, we will be able to look at the outcome both in IAS 1 but also in IFRS 18 layout. And that is where we have updated our reports so that we now can view our reports in both ways simultaneously. So we can look at it in both ways. When we go over to 2027, we will change our layout once again, but we will always be able to see 2026 in both layouts. So that's really good, and I think it's very useful to understand the layout straight away right now instead of hustling with it in 2027. But in our process and in our work with preparing for IFRS 18, we also have to go into our processes and the ERP systems in all our companies to understand which account are relatable to the new categories in the income statement. And in some places, we have to add new accounts. Like Dina said, the effects differences are, it feels like they're always some kind of trouble, because the basic of it is pretty logic and pretty easy to handle. But when you look at the effects, you might need to split those out and really understand where transactions come from. And that is in general, in all consolidation, you need to have an understanding of the business and where transaction actually happens. And one point we do at Exsitec, which is not added here, is that we do this together with all the finance functions in each company, so that everybody understands why they need to update their ERP system so that we can get the information we need. So look at the details and keep in mind the effects regarding each transaction. That is very important and very good to have a understanding right now.
We should maybe also mention there that from IASB, it hasn't been really clear on the effects related to intercompany and how they should be categorized, whether they belong in the operating or in the investing or financing category.
Yeah, it feels like, yeah, it's one thing they didn't really, that hasn't been really been clear yet. So that is still to be decided, it feels like. But I think they will come to a conclusion on that point as well. Yeah, so that is a bit about how we do it at Exsitec, and also why you should act now. That, from my point of view and from my experience, the right time to start is right now. And at Exsitec and Consolidator, we are of course eager to help you with the setup or with the thinking and logic of the setup, but it's much easier to make something happen now before you move into 2027 when it's goes live. And now we're in April. It feels like almost a year to next new year, but it's like everything, it goes fast. So act now and save some time in the yearly closing. And I would actually want to speak some about why you should consider Consolidator and why we use it at Exsitec. And so this is from a user perspective, not an expert like Dina. But with Consolidator, in regards to, especially in regards to Excel, but also other systems, it's this, when you the speed of it, that you actually can consolidate and save so much time with the system and automatic journals in Consolidator, and the set of rules that is really, really brilliant in Consolidator. So you can do the consolidation much quicker and save a lot of time. And the time we save at Exsitec, we instead use in analyze the numbers and really understanding and dig into the numbers. And it's also really reliable. The numbers are always accurate, and you have such a good traceability from an account in a legal entity right down to where it goes into the consolidated statements. So that is really brilliant. The audit trail is a brilliant thing, which our auditors really love. And you also have the full transparency and control of your data. As I said, nothing happens in a black box. Everything is presentable clearly, so you can see. You can always see where the numbers come from. Nothing happens in a black box, and everything has to be in balance for you to be able to work with it. And Consolidator is really cost efficient. It saves a lot of time and ensures accuracy. Yeah. Do you want to add something? Did I present Consolidator okay?
I liked it very much. Yes.
Yeah. Perfect. And I believe that's all from us here today. We will send out the presentation afterwards to all of you that been listening. And as I said, we at Exsitec and also at Consolidator are of course open to discuss more about this. So please get in touch if you need help with something, or you want to look at the processes or the details of which we have spoken today. Okay? Perfect. Thank you, Dina.
Thank you very much, Edwin.
Perfect. Bye.
Bye.